What's going on, guys? Bexio back, and today we got a brand new video with the stock market crashing and burning, and even crypto doing the same. Why is this happening? And is there something, the Fed, pretty much the typical target here, that they're pushing out, the rate hikes? Everyone's still about that. So we'll see, dig down into this and see what's kind of going on, as well as the interest rates, the yield curve. Everything that the Fed is doing is basically to go after that yield curve, and it pretty much worked. But we can look at the beginnings here of why S&P 500 dropped more than 1% to start the week. So today S&P is down. All indexes are down. Everything is just down. So you can see the big thing right here. Moves came as the 10-year treasury yield hit a high of 2.78% earlier Monday morning, or its highest point in 3 years since January 2019. That already by itself, massive for the bonds to be that high. We can see this is the 10-year here. Basically, since last month, March 4th, just been a skyrocket trail up. That's when rates started going up and the talks of rates started really happening. And we saw the yield curve start to invert. It hit its inverted level, which is this right here. You can see this line right here. We can zoom in a bit on it. Basically, we came all the way down, and inverting means going below zero or going negative. That's when the 2-year bond has a better yield than the 10-year bond. So short-term debt yields more than long-term debt. It doesn't really make sense. So that's why it's a problem when you have something like this happen. But as we're seeing, it went under for a little bit, not too long. So March 31st, it dropped. April 1st, it stayed under. April 4th, and then it started a big rally up. And I think this is what the Fed was really trying to focus on, making sure that these yields don't go inverted, because we don't want that to happen. We can see when we zoom out from here, every time you have a yield inversion, it usually leads to a recession. So you can see this earlier one was in 2019, 2020. That this is argued where maybe if this would have happened without a pandemic, we wouldn't have got a recession, which might be what we're looking at here, because we came down and touched it and got a very, very short recession, but only really caused because of a pandemic. And then this right here, we're seeing it basically the same thing, kind of bounce off of it. So we'll see if something accelerates a recession, or if, it doesn't even matter. And when you hit here, you just get a recession. So, but you see it every time right here, recession, came down to this level, recession, down to level, recession. The only time would be somewhere around here, maybe, where it came down and bounced, but eventually it came back down and, caused a recession. So maybe we're just delaying the inevitable with something like this, where we come down and bounce, come up a little bit, and maybe we come back down and get this yield curve, which would not be a good thing, which would cause a recession, which is just bad for everybody. But during a recession, that is the time you want to buy stocks and buy assets, because they're all going to be beaten down. And after a recession, assets usually go up pretty quickly in value. Also, we have see Monday's moves come as traders fret over rising inflation in the US. On Tuesday, Wall Street will get the latest readings on the consumer price index, which economists expect will reflect another sharp jump in prices. So that's another huge reason, kind of pricing in this next inflation reading, CPI data, because it's looking like it's going to be very bad. Probably like 9%, close to 9%. And it's just not getting any better. So looking at that, it just gives the Fed more reason to raise rates, more reason to kind of look at this and say, we got to get this under control now. And it might force a recession, because they don't want inflation to just take off, go from, we're having at 7%, 9%, then quickly get to 10, 14, 15. They start to get into like hyperinflation, which is a massive problem. And then to add on top of all of that, we have Mester added, the COVID lockdowns in China will exacerbate the supply chain issues that are contributing to inflation in the US. China has another breakout, shutting down their country. I think they're shutting down certain parts, or think about shutting it down. but that'll obviously affect supply chains, be terrible for supply chain, and make sure that getting stuff is still more difficult. So, economics 101, you got supply demand. If your demand's high and your supply is low, prices have to go up. So, if prices go up, that's going to cause more inflation. And we can see it in the stock market. I mean, we just look at this. Every single thing is red except for the VIX, which is the market volatility. Palantir's basically break even here. Robinhood's actually have up 1%, which is crazy. And, the meme stocks not doing too bad. So, a little bit of things going on. Small, very small amount of green, with the vast majority being red. But we look at the big tech companies, they're going to be the ones that are hit the hardest, and risk companies, because people take money out and put it into the bond. When bond rates go up like this and they're nearing 3%, and rate hikes are still coming, that there's more of a chance that investors pull their money out and get ready to buy bonds so they can secure a gain, because bonds are the safest things you can invest in. It's basically guaranteed you're not going to lose money. It's not going to default. You're going to be good. But it's going to pull money out of tech. It's going to pull money out of risk stock. It's going to pull money out of low cap stocks and put it into bonds. But we're not seeing the buying yet. I think once we get over 3% or more rate hikes happen, it's going to be more attractive for investors to buy bonds than it is to buy stock. I mean, just look at things like Apple, down almost 2% today. The S&P down 1.17%. All of these massive companies, Amazon's down, Google's down almost 3%. That's ridiculous. But even cryptos, I mean, you look at Bitcoin, down 4%. We've just been on this plummet here from all this news, uncertainty, rate hikes. It's considered a risk asset for obviously investors. So when you look at bonds going up, anything that's a risk asset, money's going to come out, money's going to go into the safe haven kind of investment like a bond. This is probably going to be short-term stuff. Obviously, it's not going to be Microsoft down over 3%, ridiculous, but this types of moves probably aren't going to be massive moves. They're not going to be something that affects the market for a long period of time. I think we're going to have the freak out. It might be some weeks. It might be a few months, but this news always, when inflation starts to come about and talk to the interest rate hikes, once we get past these new introductions like they've been pushing, then we can start to price in the markets and start to get back to kind of a normal market instead of relying on what's the Fed going to say? Is it good or bad? React. And we can see how all eyes are on the Fed right now, because right here, Fed officials indicated in minutes from last month's meeting, they were considering raising the US benchmark rate by double the normal amount of upcoming meetings. They also indicated they would shrink the Fed's bond holdings, which would push up long-term borrowing rates. So if they were to double the normal amount of upcoming meetings, that gives them a lot more meetings to up the interest rate. So if they're upping by 0.25% per meeting, if they only had like 6 meetings left, that's whatever it would be. But if they double it to 12 meetings, then they double the amount of times they're going to raise the interest rates. Interest rates go higher. That leads on to less risk on, putting money into bonds, and they're selling their bonds. So the way a bond market works like this, so the Fed has a lot of bonds. They were buying bonds when in 2019, 2020 to force markets, prop up markets, get everyone investing. But when they start selling bonds, this rate goes up. So not only do we have selling pressure from the Fed, we have interest rate pressure going up from the Fed, and there's just a lot of things going on with bonds, where bonds are boring, but you got to pay attention to bonds, because if this rate goes to 3%, 3.5%, 4%, that's going to be massive incentive for investors to buy the bonds and not go into the stock market. Why would you want to get a risky return of 7 to 8% in the stock market if you can get a guaranteed return of 3.5%, 4% in a bond? And finally, of Wall Street, we'll also start to give more details about how individual companies performed during the first quarter and what they expect moving ahead. Delta Airlines, JP Morgan will report their latest financial results on Wednesday, while United Health Group and Wells Fargo Citigroup report theirs on Thursday. So we'll get a little bit more insight into how things are going on the companies level. That's a big earnings things. The big banks kind of seeing how the money's financials are doing, as well as airlines. It just kind of tells how people are traveling, people are spending money. If they're not spending money, not traveling, not doing things, then it's probably slowing down the economy and you might be staring at a recession. So, a whole lot of recession fears. That's basically going to be the main plastered word, recession. That's going to be the biggest factor in anything going on in the markets right now. Interest rates, Fed selling bonds, and the bond rate. So, those are the things you want to keep an eye on. The higher the bond rate goes, the lower risk stocks and even tech stocks are going to go because people would rather get a guaranteed return than a risky return. And then the same thing goes for Bitcoin. It's considered a risk asset. So higher bonds go, the less money finds its way to Bitcoin, just like it would with tech stocks and everything else. So we'll see how long it lasts. We'll see how much this news continues to affect markets because eventually it's going to be old news. Eventually, the fifth, sixth, seventh time we hear Fed saying we're raising rates, we're doing this, we're selling bonds, the market just go, yeah, we've heard that, whatever. And it's not going to care. So how much longer can it go on? And how much longer is the Fed going to be able to kind of control these interest rates and markets and just keep sending it down? But as always, that's going to do it for this video. Don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.